Hi, it's April 27, roughly about 11 p.m. Today's episode is titled Markets as a Discounting Mechanism. The question that is on everybody's mind currently is why are markets going higher when the macroeconomic data is so bad? So what we've seen recently is after the lows in late March, markets like S&P 500 and many other equity markets have actually staged a rebound, although not taking back the highs of February, but still roughly probably about half the decline has been already recovered. So roughly now for the S&P 500 at 11 p.m. We are at 2865. Okay. Whereas at the same time, when you look at most macroeconomic figures, whether it's US jobless claims, manufacturing figures, unemployment figures and such, you will find many of them have just really spiked up to unprecedented levels when compared to historical levels. The numbers that we're seeing today are just really mind-boggling. So it's not just the US, but everywhere around the world. So the main question is, why are markets still going up? Because why are markets still going up despite the fact that the macroeconomic data is so bad? Well, the answer is markets have discounted the bad news, basically saying that despite these really bad macroeconomic figures, the market is a discounting mechanism. It doesn't wait until the figures come out to react. It actually had reacted prior to this during the decline to take into account the bad macroeconomic figures, and therefore today it is actually looking forward. And when it looks forward into the future, it sees a brighter future and therefore is moving higher. Okay, so this is what we're looking to scrutinize today, to see whether this is true and to see what conclusions we can come up with from this. Basically, I do subscribe to the fact that the market is a discounting mechanism, but also to the extent that the market discounts what it understands. I'll give you an example. When we actually called for a temporary market bottom on March 24th in the video that we had put up on that particular day itself, the epidemic curve forecast that we put out, we had forecasted basically that at that point in time, the markets, or rather the epidemic curve, we were probably about halfway up the epidemic curve, and we said that the markets probably had bottomed. The markets don't need to wait to see that the epidemic curve has declined or has made a top, because what the market does is, once it understands that the epidemic curve is bell-shaped, it looks forward and it sees in the future that this will happen, and therefore it takes that into account and starts to bottom and rally for that matter. So today we have this so-called latest updated epidemic curve. It is from the Singapore University of Technology and Design, and this is for the global aggregate case count. They estimate that the epidemic curve would actually peak somewhere or rather it had already peaked on the 20th of April. So March 24th, when we first made this call that the markets had actually bottomed, the markets was actually discounting the fact that the peak would come over the next couple of weeks. So despite the fact that the cases rose, the markets actually rallied because it was telling itself, or it was discounting the fact that there's good news, there's light at the end of the tunnel, and therefore it was more than happy to move upwards. Okay, so we've seen that happen already, and now that we are moving to the right side of the epidemic curve where the case counts are coming down, what will happen is the markets will now start to discount the end of the epidemic curve, because again it's forward looking. So the markets can still go up a little bit more because it looks towards the end of the epidemic curve and the reopening of economies as a positive aspect. Okay, but that also shows, or rather that also results in the market starting to discount how the world will look like beyond the end of the epidemic curve. Okay, so we're already starting to see some of this discounting happening, meaning to say the market to a certain extent has a vision of how the world will look like post August, when the epidemic curve actually flattens out completely. We can see that sometimes from what analysts say. We can see that sometimes from the projection they make. Okay, so the big question mark is these projections, these estimations, these expectations, how will they actually stack up against what could be the reality of the situation after August. Okay, so that will determine whether the markets go up or down, because if they've underestimated the situation, i.e. the situation is much more worse than what they estimate, then the markets will come down. If they've estimated something which is almost equivalent to what will happen in the future, then the markets will not go anywhere, because it's just matching expectation with reality. Okay, but if the situation is much better than what has been estimated, then of course the market would rally. Okay, so we'll have a look into that to try and estimate whether we think the market's going up, down, or sideways in the future. Let's start off with trying to understand, can markets actually fail to discount things properly? Okay, in other words, can the market's discounting mechanism be faulty? I'm taking the example here of the 2008 global financial crisis. The subprime crisis, by and large, when you look at literature, it actually started in early 2007 when HSBC announced losses on its books linked to the US subprime mortgages. Back then, everybody thought it was just confined to HSBC, didn't really pay a lot of attention. But as the year carried on, things started to unravel. In April, New Century Financial, which specializes in subprime mortgages, they actually filed for bankruptcy. And then after that, in June, we had two Bear Stearns funds, hedge funds, which literally collapsed. One of them losing all its capital, I think, which is about 600 million, if I'm not wrong, and another one losing a huge chunk of its capital of about 1 billion. Then that was followed by BNP Paribas in August, which also had problems with its fund. Soon that was followed by some problem in the German side, and also in the UK with regards to Northern Rock. And the Federal Reserve came in another time to cut interest rates in September 2007. And in October 2007, UBS announced that it too had issues with some subprime that was sitting in its balance sheet. But throughout this whole period where we had all these issues cropping up, and mainly these issues were a bit more on the credit side, okay, you had actually the stock market, which is the S&P 500, of course Wall Street. The S&P 500 went up about 7%. So what I'm trying to say here is, despite the fact that we claim that the markets are a discounting mechanism, the fact that all this bad news cropped up, the markets just didn't seem to be able to put one and one together to say that eventually this would actually lead to something which will impact the stock markets. So the stock markets only came to realize this in October, although the signs were already creeping up and events were popping up between February all the way to October. So yes, there will be a point where the market realizes it's wrong, but it could be off course for an extended period of time. So that's what I'm trying to say. Okay. So another example would be actually just recently in January and February this year, when the market actually failed to recognize the potential impact of COVID-19. Basically, the market at that point in time realized that there was a situation in Wuhan, in China, but didn't consider it to be serious enough that it would actually spread outside of China into the Western Hemisphere, into Europe, and also into the US. Okay, whereas there were people who already had identified, even as early as January and February, that this potentially could be the case. So that is also a prime example of the markets failing to take into consideration known information and probably wrongly interpreting it, because thinking that it was more like SARS rather than H1N1 and what we know today. Okay, so there could be still a handful of risks that the markets today has discounted, but either has not fully discounted or sometimes even totally ignored. Okay, and I can actually categorize this into a few different types, and I call them the economic new norm and restart risk, deleveraging and associated systemic risk, the market new norm and re-rating risk, and the COVID-19 related risks. And so let's just go through some of them. Okay, when I talk about the economic new norm and restart risk, it actually refers to the fact that we will be probably, until a vaccine is found, living in a world which is totally different from the one before COVID-19, in terms of business activity, in terms of social activity. For example, in Wuhan, even after it came out, probably among the first, or China among the first country to come out from the lockdown, businesses are finding that social norms have changed. People don't dine out that much, people don't interact that much, people don't travel that much. So this whole thing basically is a new paradigm shift in terms of business activity, social norms, and it has an impact on macroeconomic outcomes. And countries, because they are now slowly lifting the lockdowns, if you take Hokkaido as an example, Hokkaido came out of its lockdown a bit prematurely and had to go back into another lockdown because of the virus came back and did a second wave. So again, we could have a situation again whereby some countries may have to re-lock down again because of the re-emergence of the virus, which I feel both the new norms and this re-lockdown, potentially even slow start to the economies kicking back in again, meaning to say it could be slowly one sector by one sector by one sector. All these, I don't think the market has really understood, and you could say we can't blame the market totally because it is truly unprecedented. But the sense I get is the market really thinks that the restart is going to be quite smooth, which I think, to contrary to it is not going to be smooth at all. Okay. The second one is the with regards directly to the markets. When you look at some numbers in the markets today, for example, the expected earnings, you'll find that Q1, Q2 is expected to be terrible, but it starts to get a bit optimistic in Q3, Q4, and even next year Q1, albeit next year Q1, because of a relatively low base this year, the year-on-year figure is bumped up a bit, but still it does suggest to you that analysts are still penning in relatively good optimistic figures in the coming quarters. Okay, and this was being mentioned by other people like this guy, Cameron Brandt, said the market is pricing in an optimistic scenario. So if we move on to look at what we call the valuation of the markets itself, from estimates that we can gather currently, the market expects from an earnings per share of about 162 in 2019, which is an actual number. The earnings per share is expected to decline by about 16% in 2020 to about 135, and then to rebound back to about 170 next year and 191 the year after. Well, when you look at it from the perspective of price earning, where it's price over earning per shares, what you get is with an earning per share of 135 and a P of 21, and this P is taken basically from a Bloomberg particular way of calculating it. Of course, there are certain ways of calculating it which may be P is higher or lower, but we're just taking this for example. You'll find that with an EPS of 135 and a PE of 21, you get an estimated valuation price of 2835, which is where we are currently with respect to the S&P 500. But if you expect earnings per share to come down, i.e., we don't think 135 is probably reflective of the markets. A mere 16% decline in earnings for 2020 is probably towards an underestimation. We do expect a bit more, and let's say if earnings per share decline by about twice that much, about 30%, it brings it down to about 100. Automatically the valuation of the market goes down based on assumption of PE of 21. But then the question again is whether someone will pay $21 for 1 unit of earnings in the current environment. And if PE gets re-rated down, then we are talking about both a re-rating of EPS and PE, which then results in a valuation which is much lower. Again, this is not our estimation, it's just an example to show you how optimistic forecasts by the markets in terms of earning per shares, in terms of PE and stuff like that, when they get revised lower, automatically will result in a re-rating of the value of the market. Very similar to the way when on the way up, market got re-rated upwards, causing it to rally. On the way down, it could easily be re-rated downwards, causing it to be sold off. Probably the most difficult thing to discount for the markets is the COVID-19 related risks. Similar to how early this year the market underestimated COVID-19, there are still many things about the virus which we don't understand. We even have situations now where young people are dying of stroke, which is related to the virus, which no one really understands. We don't even understand simple things like how someone can be asymptomatic, how long they remain asymptomatic. Why do some people, after being tested negative, after that are tested positive again? So all these things really tell us that this virus is still quite not well understood, and that in itself has what we call a risk to it. So in the coming months, one of the biggest risks is of course the revisiting, in a sense, a second wave. And if you look at just the comments here, which I've plucked out from a particular article, the CDC has already warned that there could be a second wave and it could be more dangerous, and they're not the only one. Many experts in the field agree, saying that this virus is around and won't disappear until a vaccine is found. So it's not unprecedented from the perspective that in the Spanish flu of 1918, the first wave was actually the smallest wave, and the second wave was the the deadliest among the three waves, and there was actually a third wave in 1919. So that's what the authorities or people in the medical field are worried about, and I also don't think the market itself has taken this probability into account. It probably was what we call a low probability, high impact event. a couple of weeks ago or a couple of months ago. But the way things are going, I think it's being upgraded, in my view, to a moderate probability high impact event. So this is something which I think is also being underestimated to a large extent. This relates to basically the cycle. If you look at this particular chart we have here, which is taken off the Federal Reserve FRED statistics of internet or site, you have GDP here, which is the blue line, and the household net worth in the red line. How do you read it? Basically, the blue line tells you what the so-called fundamental value is of the economy, and the red line tells you the assets of the economy held by the households, how much they've deviated away from supposedly the fundamental value. So what we see here is basically in boom times, these asset prices move very high, but they're brought back very close to the fundamental value in times of recession. Over the past 10 years, because of the low interest rates and excessive liquidity, asset prices have basically skyrocketed far away, much further away compared to the GFC and also the dot-com, from what we call the fundamental values. So if we are to assume that a recession is going to kick in, which it already has, and it will last, what will happen is the red line will start to come back down again. Of course, we're not sure whether it come all the way down or midway or somewhere near to the blue line. But what we can probably say with a high degree of certainty is, as the deleveraging takes place, systemic risk will arise. And systemic risk basically is, lack of a better word, skeletons in the closet which appear and could permeate to impact industries, economies, and so on and so forth. Yeah, so sometimes it's with regards to big companies, big financial institutions, and so on and so forth, which face trouble, and because of that, you have markets freezing up and so on. So we're already starting to see some skeletons come out from the closet. In Singapore, we have a big oil trader which is has imploded because of some losses. We had a situation with oil going into negative territory on the futures, and of course, because of the low oil prices, US shale companies are now, the shale industry is now being decimated. So many structured products are actually also facing tremendous stress, because in the run-up here, many structured products were introduced, and many of them based on leverage. So basically, when you have a deleveraging environment, some of these structured products just basically go belly up. So we are seeing now some of these structured notes, structured products being hit quite badly and losing a large amount of their original equity or capital. The run-up over the past 10 years since the low of March 2009 has set up what we call a lot of dominoes. Because of all the excesses and so on and so forth, you'll find that there are a lot of landmines sitting out there where potentially we could step on. It's no different from the dot-com and global financial crisis, except that I can actually categorize them just slightly differently. Meaning to say that in the dot-com crisis, we had related and unrelated dominoes. When the dot-com crisis burst, you then had what we call the corporate scandals, Enron, WorldCom, and so on and so forth. Okay, it could be said to be related somewhat to the excessive expansion that the economy had undergone in the prior years. So there's some relation to the bursting of the bubble. Of course, September 11 had no relation to the bursting of the bubble, and nor did SARS have any relation to it. Even the Iraq war was related more to the September 11 attacks rather than the dot-com bubble itself. So you can see that there were some related and unrelated, meaning there's some market factors and some geopolitical factors, including this health related issue here. Okay. In the global financial crisis, it was more related dominoes. As you can see, every bursting of these mini bubbles here and there, all the way from 2007, Bear Stearns, BNP Paribas, Northern Rock, Iceland, UK, Northern UK again, and then Fannie Mae, Freddie Mae, all these Lehman Brothers, of course, all these are actually entities in the financial system itself, financial institutions. So most of them were all related to the financial system freezing up, and so on. Yeah, so more related dominoes. In today's environment, I think it's going to look more like the year 2000, where we have related dominoes, and I think most of these dominoes won't come from the financial sector, but will come from the corporate sector. That's where we talk about the triple B's, corporate debt, high yield debt, over leveraged companies, and so on. Yeah, so we could see a lot of issues from that sector, but there are also the unrelated dominoes, which are the geopolitical ones. Even the fact that the virus hasn't been settled yet, that's an issue. We could see geopolitical tensions between China and the rest of the world, who's blaming China now for the virus, and so on. So I won't be surprised if the dominoes tend to stack up a little bit more like 2000 versus 2008 for this current situation. So in summary, I think the markets will soon have finished the positive aspects of the epidemic curve. It's discounted the peak, we've passed the peak, and now it's discounting all the way to the end of the curve, probably in August. So there'll be some slight upside, but very soon that will finish. Then after that, it really has to start measuring what it has discounted in terms of post-August. And I think that's where we will see the market realizing that a lot of what it has originally discounted is insufficient vis-a-vis what reality will be post-August. Okay, and as a result, price will have to adjust lower. That doesn't mean that if prices adjust lower, that there are no opportunities. There are opportunities out there, but I think investors have to be very selective, and we are coming up with seminar or webinar where myself and my colleague Victor would be addressing what we see as the correct strategies to use in these kind of markets, where markets are biased to the downside, and where do we find the opportunities to benefit from such a situation. So if you want to join us for that webinar, please go to our Financial Alliance Facebook, and you will be able to obtain a link from there. Okay, so as usual, if you find this particular episode useful, please do subscribe to our YouTube, and then we'll probably meet again either at the seminar that's upcoming or at a later date with another video. Otherwise, thank you very much and stay safe.